In Baghdad, a single number is supposed to anchor an entire economy. $1 equals 1,300 dinars, the kind of clean, confident official rate that implies order, control, and normalcy. But on the ground, another number has been quietly doing the real work. In exchange shops, the same dollar is effectively being priced closer to 1,178 dinars, and that gap is not a rounding error. It is a pressure gauge. Not months, not weeks, in a matter of days, the spread between the official story and the street price becomes the market's way of saying something is tightening. They said this kind of divergence could be contained, and that modern payment systems and compliance filters would keep everything aligned. Yet the moment access to dollars gets even slightly restricted, the parallel market doesn't wait for a memo. It reprices reality immediately. And here's what makes this so important. Institutions already understand what a widening spread means because they have lived through it, modeled it, and used it as a signal long before it appears in headlines. The public is usually shown one number. The market reveals the other. What I'm about to lay out changes how you interpret every stable announcement you hear from this point forward, because the stress is rarely announced. It is measured. Welcome to Macro Signal Room, where we decode what matters before it becomes a talking point. If you've ever felt like the official narrative arrives polished and late, while the real story is messy and early, you're in the right place. Subscribe if you like analysis that treats markets like systems, not slogans, and drop a comment with where you're watching from. Because these patterns play out differently depending on where cash, trade, and confidence actually move. Now let's walk through what happened and why the divergence itself is the headline. On January 9th, 2026, reporting circulated that the Central Bank of Iraq confirmed 1,300 dinars per dollar as the exchange rate for the 2026 budget framework. That announcement sounds technical, almost boring, like an accountant's footnote. But budgets are not just spreadsheets. A budget rate is a public anchor. It is meant to signal stability to ministries, contractors, importers, and households that depend on priced goods. Yet, at roughly the same time, the parallel market was quoting something else. In Baghdad, exchange shops were selling $100 for 147,800 dinars. Convert that, and you're staring at around 478 dinars per dollar. Other cities printed slightly different numbers, but the message was the same. The street was pricing dollars above the official anchor. Under normal conditions, you expect a small spread. Every currency system has friction. There are fees, documentation, timing delays, and the simple cost of operating a cash business. But a spread this wide signals something different. It suggests that the problem is not convenience, it is access. When the official rate is a promise and the street rate is a price, the spread tells you how much people are paying to bypass constraints. This is where it gets interesting. The central mystery is not that an unofficial market exists. In many economies, it does. The mystery is why the gap persists and expands even when the official rate is repeatedly affirmed. If the official price is real, dollars should flow at that price. If dollars do not flow at that price, then the price is real only on paper. That's the contradiction. To understand why this matters, you need the historical pattern, because this playbook is older than today's headlines. In 2015, Iraq faced collapsing oil prices that strained state finances and tested the currency regime. When dollar supply tightens in an oil-linked system, the first symptoms appear in settlement delays, not speeches. Importers scramble for dollars to pay suppliers. Banks become cautious. The public hears assurances, but the market watches availability. In 2020, another shock hit, and global dislocation transmitted into local currency stress. Oil revenues fell sharply, fiscal pressure built, and Iraq eventually adjusted its official rate in late 2020, a formal move that acknowledged what markets had been feeling. The lesson from 2020 is that even a strongly stated official rate can shift when the underlying flows cannot defend it. Then in early 2023, the pattern became unmistakable. As compliance and controls tightened on dollar transfers, the black market surged dramatically. Reporting at the time described black market pricing around 1,750 dinars per dollar compared with an official rate around 1,260. That's not a small deviation. That is a system under stress, with a parallel market pricing scarcity and risk. In 2026, the pattern is not identical in magnitude, but it rhymes. A lower official anchor is being presented as a stabilizing decision, while cash markets imply a premium. When you see that, you should immediately ask the question that history demands: what is restricting the flow, and who is adapting first? Because when currencies diverge, institutions move before the public notices. And those moves leave footprints. One footprint is the behavior of banks and payment channels under tighter dollar access. When traditional transfer routes face heavier screening, the system looks for alternate rails. In Iraq's case, one documented example from the earlier stress period was a dramatic jump in cross-border card transactions. Suddenly, flows that used to be measured in tens of millions per month became measured in billions per month. That is not a consumer shopping spree. That is a rerouting. Think about what that implies. If an institution can't access dollars easily through one channel, it will attempt to settle through another that is permitted, faster, or less constrained. Card networks, correspondent banks, and settlement partners become part of the story. This isn't conspiracy. It's incentives. The system will always find the path of least resistance, and when that path narrows, the price of access rises. Another footprint is the behavior of exchange houses and cash dealers. Their quotes are not theoretical. They are bids and offers based on what they can source. When they quote 147, 800 dinars for $100, they are telling you the marginal dollar is expensive. That can happen because dollars are physically scarce, because dollars are legally difficult to acquire, or because the risk of acquiring them has increased. Often, it's a mix of all three. Now zoom out and look at the institutional layer above those shops. A central bank can set a policy rate. It can influence bank behavior. It can instruct financial institutions on documentation, verification, and transfer rules. But it cannot force private actors to pretend the marginal dollar is easy to obtain if it isn't. When the marginal dollar is hard, the spread appears. This is the dislocation. Two markets, two messages. And one says stability, the other says stress. And the dislocation has consequences that are measurable, not rhetorical. Iraq imports a significant share of consumer goods, industrial inputs, and food-related items. When importers can't buy dollars at the official anchor, they pay the street premium, and that cost moves through the supply chain. It becomes higher shelf prices, thinner margins, delayed shipments, and sometimes shortages in specific categories. Not because goods do not exist globally, but because the local system is paying more for the same settlement currency. Here's the part. No one is discussing enough. The spread functions like an invisible tax. It is not legislated, but it is collected. Every time a business pays an extra 178 dinars per dollar relative to the official anchor, that difference accumulates across shipments, invoices, and payroll decisions. For a large importer, that spread is not a headline. It is a line item. Now let's put hard numbers around the divergence, because numbers turn narratives into systems. If the official anchor is 1,300 and the street pricing is about 1,478, the difference is 178 dinars per dollar, 7%. That means the street market is pricing dollars about 14% more expensive than the official anchor. In currency terms, that is a premium large enough to change behavior. It encourages people to hold dollars. It encourages merchants to price goods defensively, and it encourages institutions to seek alternative access routes. But the more telling aspect is not just the size of the premium. It is the persistence of the premium. A one-day spike can be noise. A persistent spread is structure. It says the market believes the constraints are not temporary. So, what creates persistent constraints? This is where mechanism matters. In a modern banking system, the availability of dollars is not just a question of reserves, it is a question of distribution and compliance. Even if the country earns dollars through oil exports, those dollars move through banking corridors that may be subject to screening requirements, documentation, and settlement checks. When those checks tighten, the flow slows. When the flow slows, intermediaries ration access. When access is rationed, the street market steps in and reprices. Imagine a city with plenty of water in the reservoir, but the pipes to certain neighborhoods are narrowed. The official price of water might stay the same, but the neighborhood price rises because the marginal liter is harder to obtain. People pay delivery services, intermediaries, or they travel farther. The reservoir level isn't the immediate issue, the pipe is. That's what a widening USD-IQD spread often reflects. Not an immediate collapse, but friction in the pipes. These frictions can appear through policy adjustments that seem technical, a requirement for more documentation, a stricter set of compliance filters, a narrower list of permitted transaction types, a more aggressive auditing process. Each step can be justified on paper, and each step can reduce the speed and breadth of dollar distribution. The economy then experiences dollar scarcity at the point of use, even if reserves look adequate in aggregate. Now remember the institutional behavior during prior stress. When one corridor narrows, flows reroute. That's why alternative settlement channels suddenly grow. That's why certain payment instruments spike. That's why cash premiums rise. And this is where timing tells you more than speeches. When the budget anchor is reiterated, it is a signal of intent. When the street price widens, it is a signal of constraint. When payment channels spike, it is a signal of adaptation. Put them together and you see the system negotiating with itself. So what does this mean going forward? Historically, persistent dislocations like this resolve in predictable ways, because systems cannot run on two truths forever. The first resolution is increased supply at the official channel. That can happen through policy loosening, faster approvals, or mechanisms that expand access to dollars at the anchor rate. If that occurs, the spread narrows because the marginal dollar becomes less scarce. The second resolution is tighter enforcement against the parallel market. That can compress the spread temporarily, but if the underlying access issue remains, the pressure simply shifts elsewhere. The spread may narrow in public quotes, but reappear in hidden fees, delayed settlements, or unofficial premiums embedded into pricing. The third resolution is a de facto repricing through the structure of access. The official anchor remains, but the effective rate that businesses face becomes higher through charges, commissions, or limited allocation. This is how a system can maintain an official number while allowing a functional reprice. The public sees stability. The economy experiences adjustment. You don't need a prediction to understand the path. You need indicators. If the spread continues to widen, historically, the system is signaling that constraints are still binding. If the spread narrows rapidly without a clear expansion in official access, historically, it may reflect enforcement or temporary cash injections. If official channels begin clearing transactions faster and the spread narrows, historically, that indicates a genuine easing of the pipe. Watch the spread. Watch settlement speed. Watch the behavior of import pricing. Watch whether merchants quote prices in dinars confidently or prefer dollar references. These are not ideological signals. They are mechanical signals. Now, let's talk about the divide, because this is where information becomes advantage. Most people are trained to watch the official number because it is broadcast, repeated, and printed in formal documents. It feels authoritative. But markets are not run by authority alone. They are run by access, incentives, and flow. The spread is where those forces show up first. Those who understand this don't need to be smarter. They need to be attentive. They recognize that institutions move first because institutions cannot afford to be surprised by settlement friction. They build alternate rails. They hedge operational exposure. They adjust pricing. By the time the public hears the story, the system has already been adapting. And that's why a Dinar stress watch isn't about drama. It's about reading the instrument panel. Under the official rate is the speed limit sign. The street rate is the traffic. If the sign says the road is clear but the traffic is jammed, you don't argue with the sign. You plan around the traffic. Here's where it gets even more revealing. When authorities emphasize the official anchor, they are not necessarily lying. They're signaling the policy target. But a target is not a transaction. A transaction happens at the margin, and the margin is where scarcity prices itself. So the question isn't whether the official number exists. The question is whether the system can deliver dollars at that number at scale, consistently, without delays or hidden costs. If it can, the spread collapses. If it can't, the spread persists, and the stress continues. Let's slow down and name the players, because the system is not abstract. It is built out of desks, rules, and incentives. At the center sits the Central Bank of Iraq, the institution that sets the official exchange policy and manages the channels through which banks can access dollars for trade settlement. Alongside it sits the Ministry of Finance, which needs a usable rate for budgeting, payroll planning, and contracts. Then come the commercial banks, which translate policy into approvals, transfers, and settlement. After that come the exchange houses, which live closest to the cash economy and react fastest to daily shortages and cash demand. In calm periods, these layers line up. The central bank supplies dollars through banks. Banks clear transfers. Importers pay suppliers. Exchange houses handle small flows. The official rate and the street rate sit close enough that most people don't notice. But in stress periods, the hierarchy flips. The cash layer begins to lead because it has fewer buffers. It can't wait on approvals. It has to price the next dollar right now. Now add the external layer, the one most viewers sense but rarely see. Dollars settle through international corridors. That means correspondent banking relationships, screening requirements, and a compliance environment that can tighten suddenly. When those constraints tighten, local institutions inherit the friction. A ministry can set an anchor, a bank can want to clear a transfer, but if the corridor is narrowed, settlement slows. And when settlement slows, the parallel market reprices. This is why timing matters. An official anchor can be reaffirmed on a specific date, but the parallel market is responding to the rolling reality of approvals and availability. The parallel market is not debating policy, it is pricing the weight. The street rate is not only a price for dollars, it is a price for certainty. If the official channel might take days and a shipment is sitting at a port, certainty has value. That value becomes the premium. A spread like this can be produced without any dramatic single event. It can be produced through a sequence of small frictions that compound. First, documentation requirements increase. Second, banks become cautious because compliance risk has a cost. Third, importers experience delays, which means they seek alternate settlement paths, which often means cash. Fourth, cash dealers face higher demand for dollars, but their supply is constrained, so they raise the price. Fifth, merchants adjust prices in anticipation of restocking costs. This is why dislocations matter. They leak into everything. When the spread widens to double digits, markets often enter a feedback loop. People who can access dollars hold them, because holding becomes attractive when the currency is expected to weaken in the parallel market. People who need dollars rush to acquire them because scarcity may deepen. That increases demand further. If the official channel doesn't expand quickly, the spread can widen again. But there's another force that can counteract the loop: flow through the pipe. Iraq's dollar inflow is linked to oil revenues. When revenues are steady, the system has capacity to supply dollars. The question is whether that capacity can reach the parts of the economy that demand it. So forward analysis isn't about predicting a single number. It's about mapping scenarios that history suggests. One path is easing. Official channels improve access, and the marginal dollar becomes easier to obtain, so the premium shrinks. Another path is surface stability with hidden costs. The official number stays, but fees, rationing, and delays keep the effective cost higher for real trade. A third path is renewed widening that forces a more visible adjustment, either by expanding access dramatically or by shifting the stress into shortages and delayed trade. The key lesson is that when spreads persist, something in the system must absorb the difference. What should be watched concretely to understand which path is unfolding? Watch whether street rates in different cities converge or diverge. When markets are calm, geography matters less. When stress is rising, premiums can differ city by city, reflecting local supply and enforcement. If the spread widens everywhere at once, that suggests a systemic constraint. Watch the behavior of trade pricing. When merchants begin referencing dollars more often, it can signal that the dinar price is becoming harder to set confidently. When merchants keep quoting in dinars but adjust frequently, it suggests the system is trying to maintain normalcy while absorbing volatility. Watch bank behavior through the lens of speed, not the stated policy, but the lived timeline. If transfers clear faster, the pipe is widening. If transfers slow and complaints from trade participants increase, the pipe is narrowing. Watch official communications for the difference between intent and mechanism. Announcing an anchor is intent. Announcing a process that expands access is mechanism. Markets respond to mechanism. And the point that ties the story together is this: the divergence is not merely about currency. It is about trust and settlement. In any economy, money is a claim on goods and services. But in a trade-dependent system, the ability to convert local currency into settlement currency is the heartbeat. When that conversion becomes uncertain, the economy begins to operate in layers: official on paper, unofficial in practice. The spread is the boundary between those layers. So when you hear the rate is stable, translate it into the question that matters. Is access stable? When you see a street quote like $147,800 for $100, translate it into what it represents: the price of access, the price of certainty, and the price of a narrowed pipe. This is not opinion. This is pattern. And patterns, when repeated, become tools for reading what's coming next. There's also a second dislocation hiding in plain sight: the difference between the quoted market rate you might see on screens and the cash rate you can actually transact at. Screens can print a level near the official anchor, especially when they are referencing policy settings or formal banking channels. Cash desks print what they can source today. When those two drift apart, it tells you the friction is not theoretical. It is operational. That operational friction is exactly why the spread becomes such a reliable early warning indicator. Inflation statistics arrive with a lag. Budget revisions arrive with a lag. Even public policy debates arrive with a lag. But the spread updates in real time, because it is where supply, demand, and rules collide every morning. And when you step back, the story becomes simpler. The official number is a statement of policy. The street number is a statement of scarcity. The distance between them is the cost of that scarcity. That's why the calmest way to view a dinar stress episode is as a system test. The question is not whether people are nervous. The question is whether the settlement system is clearing, whether the pipes are open, and whether the marginal dollar is becoming easier or harder to obtain. When the marginal dollar becomes easier, spreads compress. When it becomes harder, spreads widen, and the economy quietly adjusts around that fact. This is macro signal room, where we decode what matters before it becomes a headline. If this connected dots you hadn't lined up yet, you know what to do. Because the question isn't whether the spread tells a story. The question is whether you'll notice the story while it's still quiet. Today.